Dividend aristocrats are the royalty of the stock market. These are companies that have successfully increased their dividends for at least 25 years in a row. They are the gold standard, reliable payers with business models that have survived every crisis for decades. I don't know about you, but I've always found this approach quite appealing. So, wouldn't it be great if we could just buy an ETF that holds only these elite companies? Right here in Europe, there are 6 Dividend Aristocrats ETFs available. Today, we're checking them out. Interestingly, they are all offered by the same provider, State Street. We have the Emerging Markets Dividend Aristocrats, the UK Dividend Aristocrats, the Pan-Asia Dividend Aristocrats, the Global Dividend Aristocrats, the Euro Dividend Aristocrats, and finally, the US Dividend Aristocrats. Each of these ETFs focuses on a different part of the world. On paper, this sounds like a perfect set-and-forget strategy. But there is a major catch that I need to warn you about right now. The official definition of a dividend aristocrat is 25 years of consecutive increases. For the European market, however, that definition has been softened significantly. In some cases, companies only need 5 years of growth to get in, which is honestly a bit of a joke. For our ETFs, here is what that looks like in practice. For the Emerging Markets ETF, companies only need 5 years of growth or even just maintaining their payout. The UK ETF requires 7 years of growth or maintenance, while the Pan-Asia ETF requires 7 years of actual growth. The Global and Euro ETFs both look for 10 years of growth or maintenance. Only the US ETF comes close to the real definition, requiring 20 years of dividend growth. As you can see, the bar has been lowered significantly everywhere except for the US ETF. But why? Well, there just aren't many true aristocrats outside of America. The word aristocrat just sounds much better for marketing than companies that haven't cut their dividend in 5 or 10 years. In this video, we're going to compare these 6 ETFs to find their real strengths and weaknesses. I'm going to be completely honest with you about what I think of these funds and which ones I'd actually consider buying. But as always, this is not financial advice, just my own opinions and experiences. For this ETF comparison, I'm using Extra ETF. Since the platform doesn't offer native English support yet, I simply translated the page with my browser. So don't be surprised if a few words look a bit strange. Let's get into the basics. Here you can see all 6 ETFs side by side. In this view, they are sorted by fund size, which means the popularity increases as we move to the right. The good news is that every fund is at least 13 years old, giving us a long and reliable history to work with. Over that time period, these ETFs have grown to the following sizes. One thing jumps out immediately. The Emerging Markets, UK, and Asia ETFs have barely managed to attract investors. Having about 200 million euros in assets after 13 years is actually quite weak. It's a completely different story for the global, European, and US versions. They each hold over $1 billion, and the US version has even climbed past $3 billion. Clearly, these funds are much more popular with investors. All 6 ETFs use physical replication, which is exactly what I like to see. When it comes to annual costs, I find the Emerging Markets and Asia ETFs way too expensive, while the others are still acceptable. Now, let's take a look at diversification. You need to be aware that the number of companies in the Emerging Markets, UK, and Europe ETFs is very small, 50 or fewer. The other ETFs look much better. Here we have around 100 companies inside the portfolio. The US ETF even holds 155. And not just any companies, but those that have increased their dividend for at least 20 years. That's something you really need to let sink in. Now let's check the performance. Here we can see the total returns for each individual ETF. Since all these funds have been on the market for a while, we can go straight to the 10-year performance. Most of these ETFs delivered a total return of around 7% per year. The big exception is the UK ETF, which disappointingly didn't even reach 4% per year. The other exception is the US ETF, which put up a solid 8.6% per year. This chart gives us a visual representation of that total return performance. The comparison shown here actually goes back 13 years. You can clearly see the massive outperformance of the US Dividend Aristocrats. However, it's worth noting that its growth has mostly stagnated over the last 3 years. The European, global, and Asian ETFs are lagging significantly behind. As for the emerging markets and UK versions, they've been a total disappointment in the long run. But if we look at just the last 3 years, the picture flips completely. We're seeing a comeback from the weaker ETFs, an outperformance by the Europe ETF, and a clear underperformance by the US ETF. But since 3 years is such a short period, I wouldn't put too much weight on these recent trends. Let's head back to the long-term chart for a moment. I'm going to add the Vanguard Dividend ETF as a benchmark here. This shows you how these aristocrats actually stack up against a standard dividend fund. Looking at the long term, only the US Aristocrats ETF was able to keep pace with the Vanguard. We have to admit, though, the Vanguard ETF has seen some incredible growth over the last few years. Before we get into dividends, let's take a look at how these ETFs are actually built. Here we can see which regions these ETFs are investing in. The Emerging Markets ETF is focused almost entirely on Asia. Unfortunately, South America isn't represented at all. For the UK, Europe, and US ETFs, the regional focus is exactly what you'd expect. The Asia ETF covers the whole region, so the Pacific is well represented too. The Global ETF covers the entire world, including emerging markets, which I think is a great feature. The US share here is around 50%. That might seem high to many European investors, but it's fine for me. We have to remember that most true aristocrats are based in the US. In this view, we can see the top 10 countries for each ETF. If you invest in the emerging markets or Asia ETFs, you have to be prepared for a very high concentration in China. Other than that, I don't see much to complain about regarding the country allocation. And here is the sector allocation. Almost all of these ETFs are heavily invested in the financial sector. They're followed by industrials, utilities, and consumer staples. This is all very typical for dividend-focused ETFs. But once again, the US ETF stands out. Personally, I like the diversification here the best. Finance is only in 4th place, and the other sectors have a very balanced allocation. Interestingly, even technology is included. Did you know that Microsoft has been raising its dividend for over 20 years, making it part of this ETF? Now, I know what you're thinking. Companies like that have high stock prices, which leads to lower dividend yields. Yes, but that's simply the trade-off you make for quality dividend growers. You're trading a high yield today for a safer, faster-growing payout tomorrow. Now, let's check the cash flow of these aristocrat ETFs. We'll look at the payout months, the dividend yields, and the stability and growth of those payments. The payout months are actually chosen quite strategically. It's almost as if State Street wants us to combine several of these ETFs to get a more regular stream of income. 4 of these ETFs pay out semi-annually, while only 2 pay quarterly. In my opinion, that makes sense, as usually only US-heavy ETFs can reliably distribute their payments across all 4 quarters. Let's look at the dividend yields over the last few years. The Emerging Markets ETF averaged over 4%, which is quite decent. The UK ETF came in just under 4%. The Asia ETF sits at around 3%. The Global ETF offers a stable 4%. The Europe ETF is just under 4%, and the US ETF is just over 2%, which isn't exactly high. However, as we'll see later, this ETF has the best dividend growth. But when it comes to pure dividend yield, the Global ETF makes the best impression so far. But pure yields only tell half the story. What we really want to see are stable and, ideally, increasing dividends. After all, these are Dividend Aristocrat ETFs. So, now let's check dividend stability and growth. Here are the annual payouts for the Emerging Markets Aristocrats. Does this look like stable, growing dividends to you? No? I didn't think so either. The dividends aren't just unstable, they're actually falling year after year. Honestly, this ETF hasn't earned the Aristocrat title at all. Any random dividend ETF probably has a better track record than this. Next up is the UK Aristocrats ETF, and it's the same story here. The Aristocrat label is being used purely for marketing. During the pandemic, the dividend was cut by almost half. That is exactly what I want to avoid when I have an Aristocrat ETF in my portfolio. Okay, maybe things will get better with the Asian Aristocrats ETF, and actually, they do. This graph gives me much less of a headache. I'm not sure what happened in 2017, but aside from that year, the dividends have been very stable. They even managed an increase during the 2020 pandemic. That's a huge signal to me that this ETF actually takes its payout stability seriously. Overall, this is a massive step up from the funds we just looked at. We're even seeing a slight dividend growth of 2.5%. But to be fair, that's not exactly a massive achievement. The Vanguard Dividend ETF offers better stability and similar growth, and it does that without relying on aristocrat status or any special quality filters. Moving on to the Global Aristocrats ETF. I have to admit, I really like this one. Super stable payouts. A dividend yield of over 4%, and an average dividend growth of nearly 4% per year. Yes, stability and growth could still be better, but nevertheless, this is the first ETF in the list that might actually deserve the title of Aristocrat. The European Aristocrats ETF does deliver somewhat stable dividends, but the growth doesn't really convince me. In 2025, there were unusually high payouts, which artificially inflated the growth numbers. Without that 2025 spike, we'd be looking at 1.8% growth instead of 4%, which is honestly miserable. Frankly, if you want to invest in European dividend companies, there are better options out there. Check out this video for more on that. Finally, we come to the last one, the US Dividend Aristocrats. You probably guessed it. This time, we're dealing with a real aristocrat. This track record is a dream. The dividends aren't just stable, they increase almost every single year. Since the ETF launched 14 years ago, payouts have grown by an average of 7% per year. In other words, your payouts double every 10 years all by themselves. The biggest downside is the low starting yield of just under 2%. But if you have patience, your personal yield on cost could rise to 4% after 10 years, and 8% after another 10. All right, let's wrap this up. Today we looked at 6 Dividend Aristocrat ETFs from State Street. In my opinion, Only 2 of them actually show true aristocrat qualities, the US version and the global version. Those are exactly the 2 that I would personally buy. In fact, the US ETF currently makes up about 30% of my own portfolio. So, what about the other ETFs? I'd personally stay away from these 3. The aristocrat title here is being misused for marketing purposes. There's really no sign of actual aristocrat quality in those funds. In my opinion, the only other one worth considering is the Pan-Asia ETF. It covers all of Asia and delivers relatively stable dividends. The downsides, however, are a weak total return, a fairly low dividend yield, and high annual costs of 0.55%. All right, that's it for today. What do you think of these ETFs? Do you already have any of them in your portfolio? Let me know in the comments below. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.